At the start of the year, we said get comfortable being uncomfortable, and that has proven to be true. In the first half of the year, we've had trade tensions emerge, geopolitics flaring, diverging central banks, and increased volatility. But underneath that surface, something much more important is happening. Probably the single most important worry in markets right now is that we are living in a very different world for growth expectations. For 2 years, US GDP growth consistently beat expectations. That's what's powered risk assets. That's what's underpinned corporate earnings. But that narrative is changing. Since December, we've seen US GDP forecasts revised down from 2.1% to 1.4% by April. And it's not just about tariffs, the tailwinds that carried us through 23 and early 24. So fiscal impulse, consumer strength, inventory rebuilds, these are also fading. And that brings me to corporate margins. You know how resilient corporate margins were during the inflation boom of 2022, as companies could pass on costs to consumers. But now that pricing power is eroding and consumers are stretched. And if companies start absorbing more of these costs, those optimistic margin forecasts for 25 and 26 start to look fragile. And so how could the markets look for the rest of the year? Well, on the one hand, you have the bulls pointing to valuations. Yes, the S&P 500 is trading at 22 times forward earnings, which is 28% above the historical average. But these valuations are actually supported by fundamentals. We've just had the longest streak of positive earnings revision in a year, 4 weeks straight, the best run since December 2021. Consumer sentiment has also improved, the first uptick we've seen since December, and institutional equity positioning is still light. And so when consumers start to feel better about the future and companies are beating earnings, expensive markets can have fundamental support. And with institutionals still sitting in cash on the sideline, the paying trade for stocks is higher. But on the other hand, the bears are right to point out that markets at these levels look overbought and uncertainty still remains high as we head into the summer, which is typically a period of lower volumes and thinner market activity. And so against this backdrop, we expect volatility to persist into the second half of the year, and our asset allocation committee is positioned for 3 key things. First, quality type over hype. We are long positions in high quality, cash generating technology companies with strong moats and attractive cash flow return on investment potential. Second, we're leaning into thematics, particularly in defense and cybersecurity. Defense is evolving. It's no longer just about traditional aerospace. It's also about digital infrastructure, resilient supply chains, and cybersecurity. And third, we're building resilience through portfolio construction and active management. And this means staying globally diversified and remaining selective. And for Swiss franc-based investors, given the strength of the franc we've seen in the first half of the year, it's real returns that matter. And we're focused on assets that preserve purchasing power, where hedging costs align and quality isn't compromised. And if you'd like to learn more, go to our website, BillInvestmentInsights.com for more.